Hopefully everybody's enjoying summer. Had a chance to take in some of the Olympics, which beach volleyball under the Eiffel Tower, road cycling and around the Arc de Triomphe. They've done a really good job broadcasting and showcasing it here in Canada.
I don't know if you just saw it, but the women's beach volleyball have proceeded to the gold.
Yeah, I don't know if we're top 10 yet for medals, but given our population relative to China and the US, I think we're making a tremendous showing here.
Yeah, it's been good to watch. Let's get right into it. Episode 15, Wealth Talk. The three amigos here. Clark, myself down in Vancouver, Craig up in Kelowna. We've got a little bit of a timely edition here as the markets kind of came to life after being somewhat docile year to date. Last week, we saw volatility come back in a flurry. Markets fell a little over 13% from their highs, depending on which market you're looking at. Technology was definitely the fastest and hardest to fall. Some of the best stocks year to date have kind of given back some of that success that they've achieved, but we've seen a little bit of recovery. We're recording here on Thursday, August 8th, and we've seen some strength return. But let's kind of dig into what was behind the sudden drop in the market. Craig, what do you think was the cause of all of this?
Well, yeah, I think you can probably point the finger at a number of things that have kind of come to the surface over the past week or so. It's always important to frame it in the context of volatility, how the media relays that message to investors, and how we view volatility relative to what we're seeing in the portfolios. And if anybody's kind of listening to our messaging over the last couple of months, we've talked about some of our concerns about the valuations on some of the mega cap names that you've seen out there. In particular, I think we've highlighted a name like NVIDIA that a lot of investors were flocking to for the first 7 months of this year. We kind of talked a little bit about some of the complacency that we've seen in markets. So, volatility, I think on a very short-term basis, it's not much of a concern from our end. If you want to point the finger at a few things specifically, and we can talk about it, whether if it's some of the economic figures that we've seen, kind of the digging that I've seen is what really did change is last week you had a pretty significant change in interest rate policy out of Japan. And anybody that's followed kind of the Japanese interest rate policy for the better part of 30 years, I think I go back to the mid 90s, they've essentially been at zero rates. Had a small bump up in and around or just before the financial crisis, I believe. But for all intents and purposes, interest rate policy in Japan has essentially been zero. It's a 0.25%. So, a lot of big global investors, pension plans, institutions, endowments, what they've done is they've borrowed funds off of Japanese rates, extremely affordable, extremely cheap. And what they've done is they've invested that in assets outside of Japan, such as U.S. markets, where the return, even on safe assets, is significantly higher. And if you take that, even look at investing in some growth assets, the return potential can be significantly higher. And that's what's called a carry trade. And that's been going on for 10 years, 15 years, 30 years, let's call it. And what happened last week, the Bank of Japan raised their interest rates by 0.25%, which kind of spooked the markets. And you saw a bit of a winding of this carry trade. And there's view that a lot of these global investors had exposure to U.S. markets, in particular some of these large cap names that we've referenced, and you created a bit of a selling trap where you've seen some money came off the table in a very in a quick trading session that you saw kind of develop last Friday and into last Monday. I think a lot of that's kind of been digested now, and volatility seems to have subsided. To me, that's kind of one of the main things. We can probably talk about economic numbers and unemployment data. What are your guys' thoughts?
I think that's just one side of it. To think that the Japanese carry trade was the predominant factor in some of the downside we've seen over the last week. And hey, does that continue or not? We don't know. But the other side of that is at the same time, and I think you mentioned it, Craig, with economic numbers coming out in the States and the Federal Reserve, communicating a potential change in policy, not only do you have Japanese interest rates rising, you have the potential for US interest rates to decline. That actually exasperates that leverage in that carry trade as well.
Yep.
But I think the message out of that, let's forget about carry trades and leverage and interest rate differentials and all that. The bottom line is you've got, as you mentioned, an area of the market that's extremely overvalued, a market that's been very narrow with money almost exclusively running into 10 stocks that are AI themed. And you've now got some softness in the economy. Last week's job report is really what spooked the market, when the expectation was for July job numbers for 175,000 new jobs in the States, and it came in far below that at 117,000. That's an indication that there's some softness out there. That does lead us to believe that, hey, interest rates will start to decline moderately in the States. And if that's the case, investors come out of the market where they've been, extremely exposed to some of these sectors as well. I think that's what I would take more out of it is, we've had a good year and a half in the market. Economy has been highly resilient in an environment of rising interest rates. At some point, we just go through normal economic cycles. That the economy starts to do a little bit better than it should, a little bit overheated, and things start to slow down. And I think that's really what we're seeing here.
I think also we have to recognize that it's basically been a straight line higher from last year's kind of late summer, early fall correction where the market started to recover. And we've really seen no volatility whatsoever for almost a year, which is really unusual in the markets. So at some point, the confluence of a few things happening at once, whether it's a carry trade blowing up and weak unemployment number happens at just the right time, and all of a sudden you get some skittishness and selling begets a little bit more selling. As we know, the trend followers out there are going to jump on. The computers are going to turn on when they get the opportunity to exasperate a move like we've seen. Time will tell if this turns into a more meaningful economic slowdown and market kind of changing cycle. But as of right now, I think we're all pretty much in agreement that it was likely a little overdone to see the market fall, like I said, almost 14% in really 2.5 trading days. So what's next here for the market as far as our crystal balls are telling us as we head into the fall and a big US election?
Well, I'll say I don't think that, going back to the economic news, I don't think it should be any surprise the data that we've seen recently. We've seen that over the last number of months and number of quarters, that economic data continues to weaken. Interest rate policy coming into last week's meeting, there wasn't any expectation that they cut interest rates. So that's not new news. You're starting to see a few talking heads come out and say that there should be an emergency interest rate cut between now and next meeting, which is, I believe, in September. I don't think that's a wise move. I think that could spook the market even more, that there's maybe seeing numbers that we're not, which are progressively worse.
I think that's actually a good point. I want to touch on that because I think that's a good point. Like, there's a lot of people that are calling for this emergency rate cut, and I agree. I think that's the wrong message to send right now. I think the market did what it did, and maybe we've gone through the worst of it, maybe not. But to come out and say, okay, we need to lower interest rates when they came out 2 weeks ago and said they're not doing it is just a bad sign, right?
Well, look at their dual mandates.
It's
Inflation and dual mandates, inflation and unemployment. They've done a pretty good job managing inflation, right? It's they brought that, relatively pretty close back down to their target rate. I think it's the unemployment data now that they're going to continue to focus on, and I think that's going to be the driving force of interest rate policy.
Keep in mind that when we entered this year, the expectation was for 6 interest rate cuts in the United States, and we've seen absolutely nothing, and it's August. Part of that is the economy has been far more resilient in an environment of higher interest rates than what was anticipated. I think that's part of the reason why the market's done so well. I also think, and we did talk about this, I think when we had Ed Mills on, and we talked about it on other podcasts, that there's some political decisions behind that probably is that there's a concern that if they cut interest rates too quickly or too soon, in an election year that had the risk of reigniting inflation, which they didn't want to be blamed for heading into an election. I think now that we're starting to see some economic weakness, we saw it in the employment numbers, we've seen it elsewhere, and we're pretty close to the election. A rate cut in the next month or so. It doesn't need to be an emergency rate cut. I don't think we're in an emergency, but I think it should just be expected. Interest rates are higher than where they've been over the last number of years. Things are slowing. They can afford to cut rates a quarter point or half a point between now and the end of the year. And guess what? If they do, the Fed funds rate will still be at 5%. And, that's not a terrible thing in my view. Jay, your question here is, what do we expect for markets going forward? I think it's reasonable to expect that we're going to see some modest interest rate cuts. As we've talked about, still with that fear of inflation on central bankers' minds, we're not going to see aggressive interest rate cuts unless they're needed. So far the economy, as we just talked about, has been highly resilient, normal to see a bit of slowdown. Corporate earnings are actually holding up extremely well. We have probably a higher than average probability that we end up with what we term a soft landing, where we see some weakness. Do we see a mild recession or not? Maybe not. But this talk of despair that you see in the headlines sometimes, hinting towards, hey, emergency rate cuts are needed. We just don't see it out there at this point. The risk is there. But if that does happen, we just see the soft landing. I think the market is in a pretty good position here. The only comment I would make is the narrowness of the market that we've talked about before. We talked about a few minutes ago, where money has piled into one theme that had been working, and that's the AI theme. And a lot of other securities, a lot of other sectors have been highly neglected out there. If we do see interest rates cut, if we see the economy, slow a little bit, that's going to be highly supportive of other sectors that have underperformed over the last year and a half: telecoms, utilities, some consumer areas. And some of the rotation that we've seen over the last week or two that we have telegraphed out of technology stocks or out of the AI theme, I think could continue, at the benefit of other sectors as well.
Yeah, I completely agree. And we talked about that in the past few commentaries we've relayed to clients, that we were starting to see some of the early signs of market rotation, whether if that's utilities, as you mentioned, real estate, some healthcare names. I would view that as probably has a pretty good tailwind for the next several quarters, because valuations are far more attractive. They're totally unavoided. Big thing is last stat I read is there's pretty close to $8 trillion of cash, treasuries, money market funds sitting idle right now. And rightfully so, because, those money market funds and treasuries are, between 4% and 5% for the past 12 to 18 months. If rates continue to trend lower, some portion of that $8 trillion is going to find a home in other asset class. And I think smart money looks for a valuation that is far more attractive than, as you say, some of these technology AI themes.
What is it? Warren Buffett's also sitting on something like $300 billion of cash, which is the highest he's ever had. And he's not going to sit around for too long, especially if markets start presenting him opportunities, which is always interesting. When Warren makes a big splash, the market tends to appreciate it, like he did way back in 2008, 2009. So yeah, I think there's a lot of catalysts out there that can really not only help us recover from this little dip, but also kind of set the stage for the next phase of growth. And I think regardless of what we think is going to happen in the near term, our playbook is going to continue to be buying into these 5 to 10% dips as a good way to put capital to work for the long term, regardless of what we think is going to happen in the US election or what we think might happen geopolitically. Those things are just too hard to predict. So sticking to buy good companies when they're attractively valued and rinse and repeat, and tends to provide good outcomes for us.
And for interest sake, to add to your comments about Warren Buffett and his increased cash position, you know, a good part of that cash position recently came from, I don't know if you saw, but he just cut a stake in Apple, which was his largest position. And I believe he was, Berkshire Hathaway was the largest holder, I believe, of Apple by 50%. They cut their stake recently by 50%. That may have spooked the market a little bit in technology, but I also think it's a sign, you know, Apple's a great company. We own it. Microsoft is, Google is, we own them all. But we also, and we'll own them for years, but we also recognize, as we talked about, this sector has become quite expensive, particularly the stocks that are pure play on the AI theme, like an NVIDIA. And I think we've mentioned this before, kind of the cautionary tale of, you know, when the market becomes so narrow and money runs into, you know, names like that at any expense, you just need to be cautious. And I think, you know, a good analogy, I saw this yesterday from a colleague, was the work from home theme. If you remember kind of 2020 and 2021 coming out of COVID, when the narrowness of the market, where all this money flowed into stocks that were benefiting from this work from home theme that the market extrapolated that would last forever. Or, you know, live at home, work at home, don't leave your home. And you look at a stock like Zoom that everybody wanted to own and got up to $600, it's trading at $50 today. Or a Peloton that everybody wanted to own because, hey, everybody's going to have a home gym going forward. Got to $200 a share, it's trading at $3 today. You know, Shopify, you know, a great company, but got to $225 a share and is now at, you know, what's it at, $90 or something like that. And just, again, just kind of a cautionary tale that when the market becomes this narrow on a theme that people think is the only thing that is working, sometimes it makes sense and it's prudent to take a step aside.
Yeah, and if you kind of look at, you know, circle back to the volatility over the, you know, the past week, which is extremely short term, our portfolios have been quite resilient, and that's through diversification. Not only in the equity markets, but across asset classes. We've got cash that will tactically raise once in a while on names like Microsoft and Amazon and Google. We've got fixed income, and I don't know, Jay, Clark, if you want to comment on if there's opportunities in fixed income, but you know, as rates come down, fixed income should perform well because of that inverse relationship. So, you know, volatility to us is we're not threatened. We don't fear volatility. In fact, it should be opportunity for an investor who's prepared and has a working knowledge of what they're invested in. I think the media, they love to bombard commentaries, TV with market sell-off, bear market, only to flip that the next day and say strongest 2-day rally of 2024 for equity markets. You know, that's not smart investing.
You have to love on CNBC or wherever you get your financial news. Without fail, every time the market drops 5%, it's like headline, guy who called 2008 crash thinks this is going to be the next 2008. I mean, it's like rinse, repeat. It gets everyone's attention. People think it's going to be the, you know, next big thing. Maybe it will be. One of these days they'll be proven right, but it's like, come on, we've been through these corrections. They happen. Every year we get a 5 to 10% drop without fail. Every 5 years, you should expect at least a 20% drop. Sometimes they happen more regularly than that. Sometimes they don't. But volatility is normal for investors, like you say, Craig, for those of us that are following things on a daily basis. No one likes to see their portfolio drop, of course, but you have to look at these as long-term opportunities to get some cash to work. And ultimately, your behavior during these times is going to predict how you do over time. So it's part of the game we play, and something that we do look forward to in terms of seizing the opportunity.
In line with that, Jay, and going back to your question there, I think, Craig, about bonds, is that, you know, I think of anything kind of moving forward here is that we kind of a realization that maybe, especially with some of the sell-off and recognition in the technology names that we just discussed, that maybe a realization that other things will work in the market. And we've got interest rates coming down, which are supportive of bond prices, supportive of other sectors outside of technology, where, you know, I think that we enter into a more healthy market environment where a more traditional, long-term, appropriately managed portfolio that's exposed to some fixed income, that's exposed to sectors outside of just one narrow area, you know, I think should do quite well going forward. Whereas that's been a difficult place to be over the last couple of years with certain sectors and with fixed income. And, I think maybe that's a healthy sign for the market, that this market becomes far less narrow and a broader participating market. And, from a portfolio perspective, we're extremely well positioned for that going forward.
Yeah, it's funny. It's, periodically when I get asked, what do you think of the markets? My simple response is, well, what do you think of the markets today or longer term? If I think of the markets today, I'm going to say, I don't know, they're up or down. If I'm going to say longer term, well, the trend is in your favor, that longer term markets are favorable. Generally, though, my answer is, well, we pay attention to markets, but we manage portfolios. And within our portfolios, we own good businesses. Portfolios are well diversified. And that's how we view things. We wake up and look at markets, but all three of us, we have the, 50, 60 names that our clients are invested in, that all three of us at 6:31 in the morning take a look at and say, how are our portfolios doing? We don't necessarily say, hey, how are markets doing first? That's not how investment management is taken on the professional level.
I think was it Jack Bogle or someone said that the stock market was some giant distraction in the process of investing in companies, right? We all look at the market, it drops 13% in 2 days. And, what do you make of that? Well, it doesn't really matter if you're buying into a business that you're intending to hold for 5, 10, hopefully plus years. The day-to-day price swings, I don't want to say they're irrelevant, but it does distract you from the process of investing for the long term.
Yeah, absolutely.
Well, maybe a good place to end it for our summer edition of Wealth Talk, short and sweet. And as always, we encourage your feedback and comments and questions, and hope you enjoy. And we will pick things up when the school gets back in session, and bring your views hopefully on a higher, more stable, less volatile market in the fall.
Have a great rest of the summer, everybody. Thanks for tuning in.